Hey, and welcome back to Finance Boss. So you're in your 20s, broke, busy, and just trying to figure out if cereal counts as dinner. But now's actually the perfect time to start investing. Here's how to do it without losing your mind or your rent money. Look, I get it. When you're juggling classes, a new job, trying to have a social life, and maybe, just maybe, affording avocado toast once a month, investing sounds like something for people with actual briefcases and way more zeros in their bank account. You probably think it's complicated, risky, or that you need a ton of cash to even dip your toe in. But here's the secret, and it's a big one. Your 20s are like a superpower when it comes to building wealth. Time is literally on your side, and it's the most valuable asset you have. More valuable than a fancy degree, more valuable than a lucky break, and definitely more valuable than that collection of slightly used textbooks you're hoping to sell back. We're going to break down exactly how to turn that time into actual real money, even if you're starting with what feels like pocket change. Forget the Wall Street jargon and the intimidating charts for a second. This isn't about becoming a millionaire overnight by betting on some crazy meme stock. This is about smart, steady steps that anyone can take. We're talking about making your money work for, instead of you just working for it. Think of it as planting a tiny seed today that grows into a massive money tree down the road, all while you're busy living your life. So grab another bowl of cereal if you need to, get comfortable, and let's talk about how to make your future self incredibly wealthy, starting right now, without needing a finance degree or a trust fund. Really quickly before we get started, I'd like to remind you that I upload frequently on this channel, so if you enjoy my videos and love financial tips and ideas, you'd might as well hit the subscribe button. It costs you nothing, and it helps me get more folks to see my videos. Okay, let's get started. Alright, so why the big rush? Why am I saying your 20s are this golden ticket for investing? It comes down to one magical concept: compound interest. Think of it like this. Your money makes a little bit of money. Then, that new, slightly bigger pile of money also makes money. And then, even bigger pile makes even more money. It's like your money is having little money babies. The longer your money has to compound, the more dramatic the growth becomes. It's not a get-rich-quick scheme. It's a get-rich-slowly but surely scheme. Over decades, the numbers become absolutely staggering. It's like a snowball rolling down a hill. It starts small, but the further it rolls, the bigger and faster it grows. Okay, so you're convinced. Starting early is key. Compound interest is your new best friend. But the next big question is, do you actually put this money? You need the right kinds of accounts, and thankfully, there are some fantastic, beginner-friendly options out there specifically designed to help you grow your wealth, often with some pretty sweet tax advantages. Let's break down the main players you should know about. First up, let's talk about retirement accounts, because your future retired self will thank you. One of the most popular for young people is the Roth IRA. The Roth part is key here. You invest money that you've already paid taxes on, your after-tax income. The magic? All the growth, all those money babies, and all the money you eventually take out in retirement is completely tax-free. Yes, you heard that right. Tax-free. Growth. This is huge, especially when you have decades for that money to grow. Imagine decades of compound growth, and then you don't have to give Uncle Sam a cut of the profits. It's a beautiful thing. There are limits to how much you can contribute to a Roth IRA each year, but even hitting a portion of that limit in your 20s can make a massive difference. And the great thing is, with many providers, you can open an account with a very small amount, sometimes even no minimum. You don't need thousands to get started. We're talking about amounts that are totally achievable. Think about it. Skip one fancy brunch a month, and boom, you're a Roth IRA investor. It's that accessible. Seriously, that $50 or $100 you might not even miss can be working hard for your future, tax-free. Next up, if you have a job that offers one, is the 401k, or its cousins like the 403b if you work for a nonprofit, or the TSP if you're a federal employee. This is another retirement account, but it's typically sponsored by your employer. Often, companies will offer a match, This is basically free money. For example, your company might match 50% of what you contribute, up to 6% of your salary. If you're not taking full advantage of your company match, you are literally leaving free money on the table. It's like your boss is saying, "Here, have some extra cash just for saving for your future." And you're saying, "Nah, I'm good." Don't be that person. With a traditional 401k, you contribute pre-tax money, which means it lowers your taxable income, so you pay less in taxes now. Then, the money grows tax-deferred, and you pay taxes on it when you withdraw it in retirement. Some employers also offer a Roth 401k option, which works like a Roth IRA. You contribute after-tax money, and withdrawals in retirement are tax-free. Either way, a 401k, especially with a match, is an incredibly powerful tool. Even if you can only contribute a small percentage of your paycheck, start there. You can always increase it later as your income grows. Then we have standard brokerage accounts. These are your general-purpose investment accounts. Okay, so you're convinced. Starting early is key. Compound interest is your new best friend. But the next big question is, do you actually put this money? You need the right kinds of accounts, and thankfully, there are some fantastic beginner-friendly options out there specifically designed to help you grow your wealth, often with some pretty sweet tax advantages. Let's break down the main players you should know about. One of the most popular for young people is the Roth IRA. You invest money that you've already paid taxes on, your after-tax income. The magic? All the growth, all those money babies, and all the money you eventually take out in retirement is completely tax-free. Yes, you heard that right. Tax-free. Growth. Imagine decades of compound growth, and then you don't have to give Uncle Sam a cut of the profits. It's a beautiful thing. There are limits to how much you can contribute to a Roth IRA each year. But even hitting a portion of that limit in your 20s can make a massive difference. And the great thing is, with many providers, you can open an account with a very small amount, sometimes even no minimum. You don't need thousands to get started. We're talking about amounts that are totally achievable. Think about it. Skip one fancy brunch a month, and boom, you're a Roth IRA investor. It's that accessible. Seriously, that $50 or $100 you might not even miss can be working hard for your future, tax-free. All right, you've got your account open, maybe a Roth IRA or a brokerage account, and you're ready to put some money in. Now comes the big question. What do you actually buy? The stock market can seem like a giant, confusing casino. For most people, the best approach is the simplest and, dare I say, the most boring. Focus on broad, diversified, low-cost options like index funds and ETFs. Think of an index fund as a basket holding tiny pieces of many companies. For example, an S&P 500 index fund holds stocks of the 500 largest U.S. companies. This spreads out your risk and keeps costs low. Over the long run, most actively managed funds fail to beat simple index funds. Another great option is a target date retirement fund, designed to be a set-it-and-forget-it solution. So, we know to invest. Hello, money babies. To invest, Roth IRAs, 401ks, brokerage accounts, and to invest in simple index funds and ETFs. But there's one crucial piece missing. Where does the actual money to invest? If you're in your 20s, chances are your budget is already tighter than your favorite pair of jeans after Thanksgiving dinner. So let's talk about budgeting, but not in a scary, restrictive way. Think of it as consciously directing your money towards what matters most, including your future rich self. First things first, you need to know where your money is actually going. This sounds obvious, but so many people have no real clue. Use a budgeting app, a spreadsheet, or even just a notebook for a month and track every single penny. Coffee, subscriptions you forgot about, impulse buys, everything. You might be surprised or even horrified at where your cash is disappearing. This isn't about judging yourself. It's about gathering data. Once you see the patterns, you can start making informed decisions. Now, before you even think about investing a dime, there's a critical step if you have it. Paying off high-interest debt. I'm talking about credit card debt with 20% plus APRs, payday loans, things like that. The interest you're paying on that kind of debt is almost certainly higher than any realistic return you can expect from investing in the short term. Paying off a credit card with a 22% interest rate is like getting a guaranteed 22% return on your money. You can't beat that. So, tackle that aggressively first. It's like clearing out the weeds before you plant your money seeds. Once high-interest debt is under control, it's time to find room in your budget for investing. This doesn't mean you have to live like a monk. It's about making conscious choices. Look at your spending categories. Are there areas where you can trim a little? Maybe it's one less takeout meal per week, brewing coffee at home instead of buying it out every day, or canceling a streaming service you barely use. Small changes can add up surprisingly quickly. If you can free up $25, $50, or $100 a month, that's a fantastic start for investing. Okay, you're fired up, you've got a plan, you're ready to start investing. That's awesome. But like any new skill, there are some common pitfalls that beginners and even some experienced folks can fall into. Knowing these up front can save you a lot of stress and potentially a lot of money. So let's talk about a few common investing mistakes to avoid so your journey to financial freedom is as smooth as possible. One of the biggest mistakes is trying to time the market. This is the idea that you can somehow predict when the market is at its lowest point to buy in and at its highest point to sell. Sounds great in theory, right? Buy low, sell high. The problem is, it's practically impossible to do consistently. Even the professionals with all their fancy algorithms and research teams can't reliably time the market. You might get lucky once or twice, but over the long run, it's a losing game. More often than not, people who try to time the market end up missing out on some of the best days of growth or selling at the wrong time. The far better strategy, especially for long-term investors, is time the market, not the market. This means you invest regularly, regardless of what the market is doing on any given day, and you stay invested. This is often called dollar cost averaging. By investing a fixed amount regularly, you buy more shares when prices are low and fewer shares when prices are high. Over time, it averages out your purchase price and reduces the risk of investing a large sum right before a market dip. So, set up those automatic investments and let them run. Another classic mistake is getting scared and selling during market dips. Markets go up and markets go down. It's a natural cycle. When you see your investment balance drop, especially if it's your first time experiencing a downturn, it can be terrifying. The instinct is to panic and sell to cut your losses. But this is often the worst thing you can do. If you're invested in solid, diversified funds for the long term, these dips are usually temporary. Selling when prices are low just locks in your losses. So, there you have it. Your crash course in investing in your 20s without needing a finance degree or a Brinks truck full of cash. We've covered why starting now is basically a financial superpower thanks to compound interest, your money-making money babies. Where to actually put your money in beginner-friendly accounts like Roth IRAs, and what to invest in, keeping it simple with index funds and ETFs. We even talked about budgeting to make room for those investments and some common mistakes to sidestep. It might seem like a lot, but the core message is simple. Start small, start now, and be consistent. The journey of 1,000 miles begins with a single step, and your journey to financial independence is no different. That first $25, $50, or $100 investment is that first step. It's about building good habits and letting time do the heavy lifting for you. Don't aim for perfection right out of the gate. Aim for participation. You'll learn and adjust as you go. The most important thing is to overcome any inertia or fear and just get started. Your 20s are a unique period where you have the incredible advantage of time on your side. Don't let it go to waste. Starting small now beats starting big later. Your future self will thank you. And probably still eat cereal for dinner, just in a nicer house. Like, subscribe, and drop your investing questions in the comments. This is Finance Boss saying, see you in the next video.